All right, the S&P finished the day with its worst day of 2025. Not the move that we were looking for coming out of yesterday. We had a little bit of a pause and setting up for a pretty decent bounce. We did not get that today. But we do have our jobs report tomorrow, so we can see if we can stop the bleeding, so to speak, the decline that we've been on with that jobs report. We'll see what kind of gap we might get to the upside by the time the market opens. That's kind of the key. Like right now, I'm going to break down again the signs that are out there. I mean, we are clearly in intermediate decline. Everything is showing this. But the question is, what kind of decline? Is it a garden variety pullback that we bounce back up, get to new highs within weeks, your typical pullback? Or is it going to be the type of pullback that fails in its bounce and then we go to new lows and we're in correction, right? That is exactly what the Russell 2000 is in right now. Will the S&P follow suit like it did at the end of 2021, where the Russell 2000 was in correction and eventually the S&P followed suit in early 2022 with the 10% decline that it had at the start in early January of 2022? Are we in that kind of pullback right now? So I'm going to show you some of the signs that are out there that kind of signal what kind of move we're going to get, because that's the question. Is it going to be a garden variety 5%? Is it going to be closer to 10? And now we're going to have our failed bounce. So I'm going to kind of give you my opinion based on what I'm seeing. The sector rotation, which is giving us a clear signal there, as well as our trade idea today, is in that kind of technology space in a stock that's kind of breaking down itself after a really strong bullish trend for most of this past year. So let's go ahead and get started. Today is Thursday, March the 6th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website on MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live videos, where I take a look at old Market Outlook trades, see whether we should stay in them, get out of them. Come down here to, you can see some of these other posts here. Come down here, click this heart. It opens up this tab. Hit that like button right there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do this day in, day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicator. As you can see, we are clearly in intermediate decline. Dark pink shading in the red line. It's no beating around the bush now. The intermediate line is in the reversal zone, so that's another confirmation. Market sentiment now is out of bullish territory, so that hasn't happened during any of these other intermediate declines. The first time that the market sentiment line has dropped out of bullish territory since last 2023, the fall of 2023 there, where we had that quasi correction, right? The correction inside of the pullback range. The short-term sentiment is still bearish. The near-term line was actually above 40 at the highs of the day today, but didn't finish there, obviously, and the momentum line dropped back into oversold levels. We're 4.5% there below the moving average, which is not too extreme, right? The 5% level is the extreme, and we're obviously not to the extreme there yet. Let's take a look at some of the other indexes. The NASDAQ 100 had a biggest down day today, down almost 3%. It's over 6% below the moving average. Market sentiment is down. The intermediate line in the reversal zone. Short-term sentiment looked positive yesterday. Closed above 40 in the near-term line. Momentum line was above it. Again, not the greatest pattern, but it was something. It was better. It was a good pattern. Relatively mildly bullish, but obviously not building on it as the near-term line's back into bearish territory and the momentum line's back down to oversold levels. So, we continue to move lower. The Russell 2000, remember, is not in an intermediate pullback; it's in a correction, right? This was its intermediate pullback. It failed on its bounce, and now to lower lows. That's correction levels. The intermediate line's down. Market sentiment's in bullish territory. It's still falling, though. It looks like it's slowing down that fall. Right? It looks like it's actually trying to go up there. Clearly below the moving average, 7%. Below the moving average there. That's the lowest of the year. Short-term sentiment remains in bearish levels, so continuing to be bearish there. And then finally, your Dow Jones Industrial Average, it's starting. It just started its intermediate decline because it had been holding up better than all the other indexes here, even during that pullback here on Monday. But then Tuesday hit, and it finally broke to the downside, broke below the bull tag lows. Intermediate lines now down in the bearish territory, now in the reversal zone. Market sentiment's flat, has been flat inside this neutral levels for a while. We've been pretty flat on the Dow Jones for a while now, and short-term sentiment again remains bearish. The near-term line's rising above still below 40 in bearish territory. The momentum line down to oversold levels. So, no real change there. Just bearish short-term sentiment, bearish intermediate posture. We need to see a good short-term surge, right? You're to the point now where we need escape velocity, right? To get off of an intermediate low, you need escape velocity, and you need a near-term line across, ideally above 40. So like right here, we had a good bullish day. The near-term line finished at 30. The momentum line was a little bit higher. And the next day, we went from 30 to 75. So across 40 and 60, the momentum line was above it at 82, almost 83 in the reversal zone. That's the kind of short-term pattern you need to get your escape velocity, which ultimately you can see we didn't really go up that much on that day, but we ultimately did. And we broke the trend and started a period of dark green shading the green line. Well, that's where we're at here. So that's the kind of pattern we're going to need. And obviously today, or even yesterday for that matter, wasn't quite that pattern yet. We were hoping to get it today, and obviously that didn't happen. And we'll see if we continue on this weakness. I expect we'll continue on this weakness. Again, we do have a red tag finally, right? At 6.6% tag there. Remember, that number can't get smaller because it's based off the close. It can get bigger if we close lower, right? So we don't want it to get bigger, right? We want it to stay around 5%, closer to 5 than to 10, so that we can have a good chance at a bounce for a new green tag in the double digits, right? That's the ideal scenario. If it does fall to 10% here without any kind of like bounce, then that leads to a failed bounce usually. Usually it leads to a failed bounce, and then we're in correction mode. So that's not what we want to see, and we'll kind of keep our eyes on that. There are signs that suggest. I tweeted out one big one. So if you follow me on Twitter, you'll see it's actually getting a lot of traction here. So I think Stock Charts picked it up, and a lot of people retweeted it, and so it's getting a little bit more traction than most of my tweets do. But there's a lot of signs out there that suggest that we might be a lot closer to a correction than just a pullback. We'll talk more about that here in just a second. Let's take a look at the weekly chart. This is one of the signs that's not working in our favor. Clear bearish pattern here. We've fallen below the 5% mark, now below 4%. So we're working our way towards zero. That's what happens during corrections. We work our way towards zero there. You can see the correction. We had this kind of quasi-correction here. It ended up being just a pullback. But this ended up being the correction where we broke through, and then we got our death cross, right? Corrections, you get the death cross here. But usually you break this 5% mark first, and you work your way down to zero, and then you break through. And that's, obviously we're working our way down. We've broken below 5, and we're, as of right now, working our way down towards zero. 3 green arrow chart, obviously you have 3 reds everywhere, right? 3 reds and a red line now everywhere. So nothing's changing. The only thing that's really close right now to a green arrow is the stochastics on all these indexes, since it's so low. It's been that bearish. When we're strongly bearish, usually the first arrow back up to green is the stochastics. Then you get the moving average kind of last because we're so far below it. Normally, when you get 3 red arrows and you bounce immediately, when you're on a bullish trend, you get 3 red arrows, you bounce immediately. Usually it's the moving average that gets the first 3. But when you've been really bearish, like you're in an intermediate pullback mode, it's usually the stochastics then that ends up being your first green, and obviously we don't have that yet. Let's take a look at the 2-line versions of these charts. You can see we're sitting on the 200-day moving average, which gives us, again, good opportunity for a bounce here, for this to play out and end right here. We can go through that and get to the 10% mark, so we're not out of the woods. But, again, the 200-day moving average is likely to hold for a support, obviously, until it doesn't. You can see the MACD has dropped below that 1% mark. That's a significant level in terms of the strength of the weakness that we're having right now. If I take a look at some of these other oscillators, like you look at the DMI, we are not quite above 30, but we're way below 20 on the positive indicator. If I look at the weekly DMI, we are now above 25 on the negative and below 20 on the positive. We haven't had that combination again since this quasi correction that we had in 2023. That's a pretty significant change there. When you look at the RSI and the CCI, we're also getting significant signs. We're below 40 here, bearish. Below 100 there, that's bearish. But it's the weekly chart that's showing us the signs of a correction, right? We're dropping well below 50, which we didn't do during all these other pullbacks on the weekly RSI. And we're way below 100. In fact, we're below minus 150 right now on the weekly. Now, things can change tomorrow because there's one more day left. But so far, you can see these are all signs of correction, not just pullback. This pullback will turn into a correction. Remember, a pullback that turns into a correction starts as a deeper pullback than normal, and then it has a failed pullback bounce. We will get a green tag on that zigzag chart, but we will bounce. It will be very rapid too. Usually, it only takes a few days to get that green tag, and then it fails. Right, the 30-day, 50-day moving averages, it fails, and then we go to new lows, and that's your correction. Right, that's how a pullback turns into a correction. So obviously, if you only have a 5% drop, it's kind of hard to get a 5% bounce without being at new highs. But when you've dropped 10%, then you can get a 5% bounce without getting new highs. And again, usually you end up failing there. If I look at the Ichimoku cloud, you can see we have a mature, or at least bordering on a mature bearish trend. We're above 80 on the noise balance at the bottom. We're not quite below minus 5 yet. We're at minus 4. Again, we haven't had a mature bearish trend. This is the closest we got there in August, and then over here we never even got there. Again, the last time we had a mature bearish trend where where we had both signs here that were at the levels was back over here again in 2023, and again it didn't last very long. We were only there for we never did get below the minus 5 here, and we were barely above 80 for just a few days on that. So before that, you have to come out to some of the bearish trends we had during the correction. This one got to a mature bearish trend. This one got to a mature trend. This was the first leg, mature trend for a few days. This one was lasted a little bit longer, and of course, the washout here in October lasted a lot longer. We were below 5 for a while. We were above 80 for a while. That's what happens. So here we are flirting with it potentially on the first leg, and the other sign too of correction. See, pullbacks, you get to the bottom of the cloud or maybe a little bit below it, you immediately bounce back up. So remember the cross of the green and the blue line is this pink shading that's plotted forward 26 days. So as long as we're back above the cloud by the time we get to the pink shading, that means we've had a pullback and we bounce back up to new highs within weeks. That's very typical. It happened there, it happened here. And it didn't happen here because we never did get the pink shading on this pullback. But now we got the pink shading and we are not bouncing back above the cloud, and we're actually pretty clearly below it. And we have a very negative rate of change. So again, another sign that this is more than what than meets the eye, so to speak. If you look at the bandwidth is rising rapidly, a bigger bandwidth than what we saw since August. We are in the lowest quartile of the bandwidth. We are trading below the lower Keltner channel again. So whenever there's a gap between the bands and the Keltner channel, we're trending when we're trading in that gap. And that momentum, we got the green dots. The momentum line is among the most bearish of the past year. Again, if I were to zoom out for some context on this, so you can see just how bearish that is. Here, let's go to and you can see the weekly. This is the weekly, and we are in the lowest quartile now in the weekly Bollinger bandwidth, closing potentially below, and you can see the momentum is switching to bearish potentially for the first time since 2023, and that's what happens during correction. Remember, this was a very weak correction, very deep pullback. It was a correction inside of a pullback range. The pullback range between the 50 and 200-day moving averages. The correction range between the 50 and 200 week moving averages. So we had a bear market inside of a correction. A lot of people would say this was a kind of a mini bear market. This happened to stay within the 15-200 week moving averages. A lot of people can say this. I mean, they had all the inklings of a correction, but it happened to stay inside the pullback range between the 50 and 200 day moving averages. And so, but you can so when a correction, this momentum switches to the downside whenever we do have those. Let's take a look now at today's intraday range. We did get a lower high and a lower low. We closed at yesterday's low, a little bit below it. We are definitely below last week's low point, and obviously you can see the high point is a lot lower too. So that's, we've still got an increasing range because of the new lows we get. We got a new low today, so that means the Arun still at 100 on the positive, and the negative is making its way down towards 0, which is where we want it to get to, so we can get a bounce off of this. If I take a look at today's range in volume, you saw the volume down there was pretty heavy, above 80 million. The range was over 10 points, so the ATR, the normalized ATR, has really jumped up. It's up well above 1.5% now. Again, that's a significant level that usually just normal pullbacks don't get to. Like, we only got it to here because we had that big drop on the Monday, August the 5th, coming off that weekend there. But then we rebounded immediately, so as it kept going higher, we're actually rebounding. So this is a little different because we've been grinding our way down. It hasn't been a big drop. It's been kind of a grind to the downside here, and it's really moved both volume and range up higher there. And of course, it's also moved the VIX up higher. The VIX is clearly above 20. It's above 25, or at least right around 25 today. It's above the 105% mark relative to the VIX 3M. The VVIX is well above 110 at 120. So we're still in this, right? We're still in this period of volatility. And if you take a look at the VIX, the VIX is, easily moving higher. In fact, if you look at the weekly chart for the VIX, we're above the 200 week, clearly above the 200 week. We had one of our biggest moves above the 200 week moving average that we've seen for a while. That wasn't a spike, right? Usually, we get above the 200 week moving average with a big old spike up to the upside. This is our biggest move that we've had since 2022 on the VIX to be above that. And if I look at the daily chart, and again, to see how far above the 200 day we are, again, we're pretty high. Let me zoom out so we can see some context here. We're pretty high here, and you notice, again, we've been higher when we've had the spikes. This hasn't been a spike. It's been a grind to the upside, similar to some of these other grinds to the upside we had over here. When we got into the low 30s, and we had, this was our last pullback on that run, and this is the first pullback that we had that turned into the correction. That bounce failed, and we had our correction up from that point. So a much different volatility scenario, what we're seeing now versus what we've seen here on recent pullbacks, where we've had like a crazy jolt of volatility that didn't last. This has not been a crazy jolt of volatility. It's been a steady increase in volatility here. All right, now let's take a look at what's driving this price action. This is the asset class comparison chart here. The dollar was your best performing asset. It was down marginally, but it was your best performing asset. Bonds were down marginally as well. Commodities were down. Remember, that's a rising dollar, a rising commodities, and rising yields, or the three-headed monster that puts pressure on equities, has in the past. Things are changing, right? We're falling. Now, granted, all three of those things are higher. Bonds are higher than equities, but commodities are higher than equities. The dollar is higher than equities, but they're not positive. And so we're starting to see a shift to where, again, it's not inflation that's a concern anymore. It's the deflationary environment, right? It's the market, it's the GDP falling to negative levels. It's the economy slowing. That's the concern. When that's the concern, stocks and bonds tend to move in opposite directions, and falling commodities tends to fall with equities, and things are moving to the downside. So you can see that you can see the dollar. Here's the yields move. The yield trying to get back up above here, but came well off of its highs today after hitting that 17-day moving average. If you take a look at the dollar, again, it's continuing to break that 200-day moving average. Again, this is generally seen as a bullish sign for equities, but has not been bullish over this past week or so. In fact, if I were to take a look, since the S&P really hit its peak, so that would have been And it's been down almost every day since. Only three up days since it hit its peak on February the 19th. But if you take a look at what it's done since the 20th, so here is the, let's go to the asset class comparison from 220. We'll go from 220 on. This is when things really hit the, started to roll over to the downside. There's your equity down 9%, almost 10% here on IWM, the Qs. The S&P, of course, down 6.5% off of that closing high. The commodities are down. Again, generally speaking, commodities would be higher. Bond yields are down. Generally speaking, bond yields would be higher. And the dollar is down. And generally speaking, dollar would be higher. So all three things that are favorable for equities, or at least were favorable for equities in 2023, 2024. So if I were to zoom out here and take a look at, here, let's go to 2023. And then we'll zoom it out to the 2-year period, but we'll start with 2023 first. Again, you can see weakness in the dollar, weakness in commodities, higher yields, but yields were flat. That really helped push prices up, right? Stock prices up, especially the Qs up 53% there. Zoom in or zoom out to the 2-year period. Let's see here. Sorry, let's try that again. To 12/31. There we go. So here's the 2-year period. The equities are up the S&P up 53%. The Q's up 100% at one point in time before finishing at 92. And yields are up a little bit, but not very much. The dollar is up a little bit again, but not very much. And commodities are down. And so again, that's not what we saw in 2022. So let's go to 2022 here. In 2022, you can see commodities were up, the dollar was up, and the yields were way up, right? Of course, the Fed was raising rates during that time. And now you can see the pressure that put on equities. So things are changing now in 2025, and we're starting to see, again, more of an impact of deflationary expectations starting to creep in. And that's when your correlation, and I showed you this chart before, but the correlation here between bonds and stocks, generally speaking, are negative, right? So it's an either-or trade in a deflationary environment. They tend to move together in an inflationary environment, and you can see right now it's negative, right? It was a lot more negative than it is now, but it was negative here, and we'll see if that continues to play out to where, again, as bonds falter, stocks rise, and vice versa. If bonds continue to rise and stocks fall, then we know that we're probably headed towards a correction. At that point, again, you look at, if I were to zoom out here and look at 2021, 2022, again, that's when we were in this strong inflationary environment, and then it went positive. After being negative for most of that period, we went pretty strongly positive in 2021. It went negative again by the end of the year, but then it went positive. Throughout all of 2022, it was pretty positive. Brief periods of time where it was down, but it was positive for most of this deflationary period. On TLT and on equities before we started to turn up. A little bit of a deflationary period there as well. It started to turn up, and then now you can see again they have a negative correlation here versus stocks versus bonds. So that's the norm, right? That's the norm. That's the relationship they have when the market is more concerned about deflation than it is about inflation. Let's take a look here at the breadth. The breadth has been relatively poor. It has not been like widespread. Like a lot of these other, like when we've hit the bottom on some of these other pullbacks, the breadth has really been pretty bad. The breadth has not been pretty bad here. It's barely below 35. It's in the 40s, and that's it. And it's only been a couple of days. We're almost below zero on the summation index. When you look at the number of stocks, the number of new lows, it's actually back below its moving average. When you look at the number of stocks above the 50-day moving average, it's still above 200, right? It's not extremely low. The number of stocks above the 200-day moving average, however, is breaking 250. This is the first time we've broken 250 now for a few years, right? It's been a while, right? We broke 250 on the downside move. Back here in 2023 when we had that, again, quasi-correction in the pullback range. and of course it broke it over here in 2022. So we've been above it for a long time, and this is the first time. And again, like I said, since 2023, so going on over almost 2 years, about a year and a half, that we've been above that. So big change there. It's pushing this up, but you notice that this ratio is not jumping up to extremes. You can see how extreme it got at that intermediate low, how extreme it got there, got up to 1.5 here, got up to 2 almost on that intermediate low, got way higher on the first leg of this quasi correction pullback. It got up to 1.5 there. We're barely at 1.15. I mean, we're above the average. The average is starting to rise, but it's hardly extreme, right? And the same thing with the money flow. The money flow to the downside here, again, is hardly extreme. It's below 40, but it's not down to sharp low levels here, closer to 20. So if I were to take a look here, let me zoom out so you can see what it looks like when we went into the correction mode over here. Like in that first leg lower, we really dipped pretty hard, and of course we did in the washout phases too. And even on that pullback, we dipped pretty hard. And that 2023, we got pretty low. As you can see right here, we are not that low. Like we are about as low as we are during typical pullbacks. So as bad as some of these charts look in terms of, there might be some more, the breadth is not washed out, right? The breadth doesn't suggest that we're at the low point of an intermediate decline, because even on intermediate declines, we see kind of a little bit of a washout, and we're definitely not seeing that yet. Now we might, as you saw, the net new highs and new lows did drop down to an extremely low level, down to below -800. We are back up to barely below -200. And so we'll see if we can get back above that average and pop back up again. That's going to be a function of these new lows, the new highs breaking out, which they're not going to break out anytime soon. Here, let's try the new highs. That's what I wanted. They're not going to break out anytime soon. They're still pretty low. But it would also be a function of not getting new lows, of this really dropping down. It is a little bit below the average, and we'll see if it pops back up above this rising average and how much further this has to go to the upside. Remember that 4% range, that's the key, right? That's the range that we really don't want to see stay up above that level, 117, because that means you have an inordinate amount of new lows that if you're not signaling the low point of these pullbacks, then you're signaling the start of something more than that. Let's take a quick look at the rotation, and of course it's that, this is why I tweeted out, the rotation's not looking good at all. This is the weekly rotation graph, relative rotation graph. You can see technology's moving down to the left, discretionary moving down to the left. In fact, that's kind of what I tweeted out here. In fact, let me just bring that up, and we'll just look at that instead. I'll have to recreate the chart here. We'll go to my profile. So you look at the drop in the ratio here over the last 7 weeks of discretionary relative to staples, consumer staples. That's a tremendous drop here in the rate of change. This is the rate of change over that 7-week period. You can see the last time, anytime we've been kind of double digits on the rate of change or more was a correction of 2022, at the very beginning there, the COVID correction, the correction of 2018, the correction of 15-16, the correction of 2011, and then the correction over here at the end of 2007 that led into 2008. I mean, those are times where there's been a significant shift in the relative rotation between discretionary into staples. And here are staples, healthcare, real estate, utilities, all moving up to the right. Energy, materials, industrials, financials a little bit moving up to the right as well. Again, those are cyclical sectors, but they're cyclical sectors that outperform, or that when they outperform, usually the S&P is not very bullish. So we're definitely getting some weakness in the most important sectors. And you know how I like to look at the technology sector, because again, it's got the biggest names in it. Here's the daily chart, obviously pretty clearly bearish, but it's that weekly chart that's really kind of hitting home. And look at that big drop there this week, a tremendous drop on this chart, breaking easily below the 17-week moving average. Of course, you can see we are already well below the 50, have been below the 50. Like, things are not looking good at all for technology relative to the rest of the stock market, the rest of the S&P 500. In fact, if I zoom in on this to a 1-year chart, let's go 5-year. This is the weekly chart, mind you. You can see we're almost below the 200-week moving average after a couple of really down weeks. Let's look at the 1-year chart now, and we'll go to a daily on this. We are easily below the 200, have been below, but flirting with 52-week lows here. And you can see that as we drop, the correlation is turning back to its normal positive levels. Not a correlation we want to see. Another one that's been kind of standing out is the growth relative to value, right? The growth relative to value. Brandon Van Zee today talked about how his 401k is actually was up today, despite the markets being down as much as they were, because most of his stocks are in dividend growth investing type stocks, the kind of the class that he teaches on Tuesday morning at Market Scholars. Look at the breakdown in this ratio, breaking the 200-day moving average as its correlation is returning back to its positive level. And if I were to take a look at the weekly version of this chart, breaking below moving averages here, big significant drop in the past few weeks. The rate of change there dropping, but that MACD is dropping, the long-term PPO is dropping, pretty clear shift. And then if I look at the high beta versus low volatility, you'll also see a pretty significant shift. Breaking below the 200-week moving, very, very significant shift. Breaking below the 200-week moving average. If you look at the daily version of this, it's obviously with the weekly chart is looking like it is. This is going to be as bad as it looks, right? Way down the 52-week lows, clearly breaking. Let me zoom out so we get some context on that chart, because we've been so bullish on the high beta relative to low volatility. I mean, look at that drop. I mean, 52-week lows, the low matching the lows of the 2023 levels. So, and then now flirting with the correction lows already. And we're not even started we only have a 5% pullback right now on the S&P 500. But you see a clear shift, that the market is rotating out of, the big three, XLK, XLY, and XLC, is rotating into the non-cyclical areas, the safety areas. And when it does that on a daily chart, it's a rotation. When it does it on the weekly chart, these rotations last a lot longer. Again, that's very typical of correction type moves rather than, so here is the end of 2021 right here. You can see 2021, XLK, XLY moving down to the left, beginning of 2022, and your staples and everything else moving up to the right, because we had a clear shift into these cyclical areas again on a weekly chart. That's what it does as you head into corrections, right? It starts to, we start to move towards safety and away from cyclical, and not just on a daily basis, but on a long term. It's a long-term shift, and that again suggests that we might be getting more than just your garden variety 5% pullback. All right, that brings us to our trade idea of the day. Let's take a look at Spotify. Spotify is obviously in that technology / discretionary space. Get a bull tag a couple days ago, really broke down below that. Still light pink shading yellow line, so we're still technically not in intermediate decline, but we are 8% below the moving average, which is the lowest we've been below the moving average, even lower than where we were with that cluster and when we were in intermediate decline back here in July of last year. So it's going to be pretty hard for us to bounce back up. Obviously not impossible, but relatively difficult for that to happen considering how far below the moving average we are. If you look at the weekly chart, again, very, very strong PPO here. The 96th percentile is turned lower, but still, the bearish candle is the biggest bearish weekly candle we've had. Again, going back over here to July or August of 2023, and that's not even that big of a candle. So it kind of goes to show how significant the weakness is compared to what we've seen in the past. Obviously, we have 3 red arrows here. This is our second day of 3 red arrows. The MACD and stochastic have been red for a while, but the moving average has finally turned red, technically today, but a little bit yesterday too. If you take a look at the 2-line version of this, obviously we're going to have a pretty wide gap there between the 50 and 200-day moving averages. Not a whole lot of volume here, a little bit of a volume right around 470, 480 or so in that area. If I take a look at some of these other oscillators, you'll see a lot of bearish patterns, above 30 on the negative indicator, below 20 on the positive. The ADX is already above 25. The RSI and the CCI are showing bearish levels below 40. well below minus 100 there. If I take a look at the Ichimoku cloud, we're not below the cloud yet. We're still, and the cloud's still green. We are below the blue line, and we've ended the bullish trend that we had, and we are now close to intermediate strength trend to the downside. The rate of change, is not negative yet, but you can see it's only a couple days away from crossing through that line. And then if you look at the Bollinger Bands and the Keltner channel, we are obviously in the lowest quartile of the bandwidth. That was falling, but it's starting to turn back up again. It's moved outside of the range of the Keltner channels. Momentum is pretty negative, and we are flirting with the lower Keltner channel as well as the lower Bollinger Band. So things are moving in the opposite direction here from what the prevailing trend had been. So what I decided to do was do a long put vertical spread, selling that low 20 deltas. Again, that 480 is right where that support is, so we'll sell down there. Got a little bit of wiggle room to work with. Got about a 4-to-1 reward to risk ratio, so that works out really nicely there. If I come back over here to, again, where the 480 is, you can see it here. It's right there, and again, earnings is going to be after the April expiration, and it's right in this area right here. So it has to basically get down to the top of the value area by April expiration and stay there by April expiration for us to get a pretty decent reward on this trade. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Thursday night, everybody, and we'll see you all tomorrow.